Hello everyone, this is a presentation for the course BKARK3053, Financial Accounting and Reporting 5 for semester A242, class of Group A. We are from Group A5 and we will be presenting our comprehensive case 1. We have selected the accounting standard, IFRS 9, financial instruments as our topic of research. This presentation is prepared for Professor Madhya Dr. Nohani Binti Aribin. These are the names in matrix numbers of the group members of Group A5.
Assalamualaikum and good morning to Dr. Nohani. My name is Naqibah Binti Nadzri. My matric number 296744. IFRS 9 was issued by the IASB to replace IAS 39, which was often seen as too complex and rule-based. The objective of this standard is to establish principle for reporting financial asset and liability, helping user assess the amount, timing, and uncertainty of future cash flow. It applies broadly to financial asset, financial liability, and derivative. However, it does not apply to every financial agreement. For example, investment in subsidiary and associate, leases, insurance contract, and share. According to paragraph 3.11, a financial asset or liability should be recognized when the entity becomes a party to a binding contract. That means we don't wait until the money is exchanged. We recognize the item once the contract is signed. Therefore, the recognition for financial asset is happen when the entity either lose the right to the cash flow or transfer the asset and give up the control over it. For liability, recognition occur when the obligation is settled, cancelled, or has expired. Financial assets are classified into three categories. First, amortized cost. For assets aimed at collecting contractual cash flow that meet the SSPI test. Second, fair value through other comprehensive income. For assets held to both collect cash flow and possess. Third, fair value through profit or loss, the default classification for the other asset. For financial liability, most are measured at amortized cost. Some, including derivative and loan commitment, are measured at the fair value through profit or loss. Entity may choose fair value through profit or loss to minimize accounting mismatch. Next is measurement. At initial recognition, financial instruments are measured at fair value plus or minus transaction cost, unless classified at fair value through profit or loss. After that, measurement depends on classification. First, amortized cost. Use the effective interest method. Second, fair value through other comprehensive income. Change are recorded in other comprehensive income. Third, fair value through profit or loss. Change are recorded in profit or loss. For impairment, IFRS 9 introduced the expected credit loss model. If the credit increase, recognized as the lifetime ECL, otherwise recognized as 12-month ECL. A simplified approach applied to the trade and now for the hedge accounting. This part was redesigned to better reflect how company manage risk. IFRS 9 recognizes three types of hedging relationship. First, fair value hedge. Second, cash flow hedge. Third, hedge of net investment in a foreign operation. The standard offers greater flexibility and better alignment with internal risk management strategy. Lastly, about the transaction. The final version was issued in July 2014 and became effective in January 2018. Company could adopt earlier and they were not required to restate previous period. Instead, they only need to disclose the impact of the change. Overall, IFRS 9 modernized financial reporting in a big way, especially in areas like credit loss recognition and hedge accounting.
Hello, my name is Tam Soon Liew. My matrix number is 297782. This next part is on how three main accounting theories were incorporated in the development of IFRS 9 financial instruments. First, regulatory theory suggests that IFRS 9 evolved in direct response to regulatory pressure following the 2008 financial crisis. The G20 explicitly mandated the IASB to reform financial instrument accounting to eliminate delayed loss recognition under IAS 39's incurred loss model. This led to the creation of the expected credit loss model, which emphasizes earlier and more forward-looking recognition of credit losses, reflecting regulators' goals of strengthening financial system resilience and reducing pro-cyclicality. Second, Pragmatic theory highlights that IFRS 9 was developed to resolve practical shortcomings of IAS 39. IAS 39 was criticized for its complexity, rigid classification, and vulnerability to arbitrage. IFRS 9 simplified classification through a dual test based on business model and cash flow characteristics, introduced flexibility for partial cash flow transfers, and implemented a 3-stage impairment model that provided earlier but operationally feasible recognition of credit losses. Finally, eclectic theory explains that IFRS 9 combines multiple approaches rather than adhering strictly to one. It integrates normative principles like usefulness and prudence, enhancing transparency through fair value options and enforcing more conservative loss recognition. It also adopts positive accounting elements such as contractual cash flow testing and empirical macroeconomic data in scenario analysis. Aligning reporting with real-world business practices together, these theories show that IFRS 9 reflects regulatory needs, practical improvements, and a balanced multi-approach foundation.
My name is Aruuna Krishnan. My metric number is 296705. I will continue with the main parties involved in development of IFRS 9. There are 3 main parties were involved in the preparation of IFRS 9. The first one is IASB, which was the main driver behind the IFRS 9. They began working on the IFRS 9 after the 2008 global financial crisis, which exposed the weakness of IAS 39. The IASB developed the IFRS 9 step by step by covering all the important areas such as classification, measurements, impairments, and edge accounting. Besides that, to create a better standard, they also released the exposed draft to the public to comment on that and held a consultation worldwide. One of the biggest changes they introduced was moving from incurred loss model to expected credit loss model. This new model allows early recognition of credit losses, help users to see the potential risk more clearly, and second party is accounting professionals such as auditor, accountants, organizations such as ACCA, ICAEWs who play an important supporting role in this. They carefully review the IASB's exposed draft and provide detailed technical feedbacks to IASB. Also, they highlight the areas where they were too complicated and too unclear, especially the challenges in calculating the expected credit losses. Many professions also emphasize the need for the clear guidance, especially for small and medium-sized companies. Besides giving the feedbacks, they also help in preparing the accounting sector through the training, educations, and publications. Because of their input, now IFRS 9 are more practical and easy to apply and more aligned with the real world accounting practice. The following party is industry player, especially bank, insurance company, and other financial institutions also play a major role on development of IFRS. What actually banks do is they will submit a comment letter and meet with the IFSB to discuss about their concern regarding this IFRS 9, where they will point out issues like high cost of collecting the necessary data and the potential burden of applying the expected credit loss model. Besides, their real-world feedback help the IFSB understand the practical challenges and lead to the changes such as clear definitions and additional implementation of guidance. This made the IFRS more flexible and realistic for companies who are most affected by the financial institution.
Hello everyone, my name is Samihah Binti Sadhakkathullah. My metric number is 296717. I will present on the nature of IFRS 9 financial instrument. First of all, we have principle-based classification. IFRS 9 is structured around the objective of providing relevant and useful information to users of financial statements about timing and uncertainty of an entity's future cash flows. The classification of financial assets is based on the entity's business model and the nature of the assets cash flows. The entities must consider how they manage their financial assets, whether they hold them to collect cash flows, to sell them, or combination of both. Moreover, the standard looks at whether the cash flows are solely payments of principal and interest. This classification approach requires entities to apply judgment in assessing their objectives and the characteristics of the instruments they hold. Moving on the second one, forward-looking impairment model. Expected credit loss model for impairment, shifting away from the old approach that only recognized losses after a credit event had occurred. Under this new approach, companies must assess possible credit losses using reasonable and credible information such as forward-looking data forecasts to estimate potential credit losses. Entities must use their own judgment and internal data to ascertain what is relevant and important in their specific context. The third one is real-world hedge accounting. The hedge accounting rules were created to better align with how businesses actually handle financial risks in the real world. The more flexible principle-based approach of IFRS 9 allows hedge accounting to reflect an entity's actual risk management strategy, in contrast to the strict regulation of the previous IAS 39. Instead of making businesses either to meet overly strict technical requirements, it focuses on establishing a meaningful connection between the hedging tools utilized and the underlying goals behind them. This shift helps ensure that the financial statements tell a more accurate and relevant story, moving away from a box-ticking exercise and towards more useful, transparent closure. The last nature of selection we have is uses terminology such as reasonably expected, significant increase, and substantially all risks and rewards, which are more conceptual than perspective. These phrases aren't strictly defined. Organizations must interpret what they represent in the context of their own business. This approach increases the need to prepare to use good judgment and support the choices with precise documentation and logic. Understanding the goal of the standard and implementing it in a way that accurately represents the entity's financial realities is more important than just following a checklist. That is all from me. Thank you.
Now I will talk about some of the limitations of IFRS 9 financial instruments. The standard brought major improvements to financial reporting, especially with the introduction of the expected credit loss model to replace the incurred loss approach under IAS 39. However, despite its advancements, several shortcomings have emerged. First, IFRS 9's reliance on subjective judgment in assessing credit risk has caused significant comparability issues. The standard does not clearly define what constitutes a significant increase in credit risk, leading to inconsistent interpretations across entities. Studies like those by Radstrom and Erickson and a survey by EY in 2018 found that this flexibility reduces transparency and comparability between financial statements. Second, the complexity of forward-looking scenario analysis adds another layer of difficulty. IFRS 9 requires entities to evaluate a range of possible outcomes and calculate a probability-weighted expected credit loss. However, the standard only provides broad principles without specific guidance, causing major diversity in the number of scenarios considered, the variables used, and the weightings applied. This inconsistency again affects comparability, making it difficult for investors to assess whether one entity is being overly cautious while another is being overly optimistic. Third, there is a lack of clear guidance on incorporating emerging risks, particularly climate-related risks, into expected credit loss models. Although IFRS 9 demands the use of reasonable and supportable information, the vagueness around what qualifies as such information leads to outdated practices. Some banks, as noted by the European Central Bank in 2024, continue using legacy models that inadequately capture new risks after declaring them immaterial without robust analysis. This high subjectivity undermines the reliability of expected credit loss estimates when new type of risks are involved. To address the limitations of IFRS 9, several recommendations can be made. First, to reduce subjectivity in credit risk assessment, regulatory bodies should collaborate with standard setters to create industry-specific quantitative benchmarks for what constitutes a significant increase in credit risk. These benchmarks would act as reference points, and improve comparability across reporting entities. At the same time, entities should be required to provide enhanced disclosures detailing the thresholds used, qualitative factors considered, validation results, and sensitivity analysis. This would maintain the principles-based nature of IFRS 9 while boosting transparency for stakeholders. Second, to tackle the complexity and inconsistency in forward-looking scenario analysis, a standardized framework should be developed. This framework should require at least 3 scenarios: baseline, upside, and downside, and include guidelines for incorporating extreme or plausible events such as recessions or market crashes. It should also provide methodologies for assigning probability weights and ensuring consistency across macroeconomic variables. Financial institutions could also form economic forecasting panels within jurisdictions to create consistent macroeconomic scenarios similar to regulatory stress testing practices, reducing the burden on individual institutions while improving comparability. Third, to better incorporate emerging risks, particularly climate risks, into expected credit loss models, the IASB should create specific implementation on guidance. This guidance would explain how to translate long-term climate scenarios into credit risk factors and how to integrate them into existing probability of default models. To develop this framework, a cross-industry working group made up of accounting bodies, financial institutions, climate scientists, and regulators should be established. This collaborative effort would promote consistency and provide a common approach for integrating emerging risks into financial reporting.
And that concludes our presentation. Thank you.